going to show you how to value ending inventory using Perpetual FIFO. Now with perpetual inventory, we know that that means we have a running inventory or an ongoing inventory. So every time we make a purchase, we record that purchase on our inventory record or inventory ledger. Every time we make a sale, we record that sale at its cost of goods sold, on that inventory record or ledger. So at all times, we have a running inventory. We have a count of our inventory. We know what we have in inventory and we know what its cost was. Now, of course, that perpetual inventory record that we're keeping won't be absolutely accurate because things happen, of course, and sometimes something in the grocery store falls off the shelf and breaks. Well, of course, your first thought is to get it up off the floor before some customer falls, gets hurt, or whatever. You don't think about taking it off of inventory. So, of course, your perpetual inventory record may not always be absolutely accurate, but it's pretty close. And if you're doing interim financial statements, month-to-month financial statements, then you can operate off of your perpetual inventory record. You don't have to count that inventory every month when you want to make a balance sheet. So there are, of course, several methods of valuing that ending inventory. So the one we're going to look at today is the FIFO method under the perpetual system of inventory. So let's look at valuing inventory using perpetual FIFO. Now I have some semblance of, this would be something similar to an inventory record or an inventory ledger, and I'm going to show what happens during the month with purchases, sales, and inventory. So let's say that on the first day of the month, we had in inventory 100 units of a particular item, and those had cost us $6 each. So our inventory at that point in time is 100 at $6. Well, on the 4th then, let's say that we sold 80 units. So our cost of goods sold would be 80 units, and our cost for those 80 units would have been the $6 because the only thing we have in inventory right now is 100 units at $6. So anything that we sell would have been part of this 100 at a cost of $6. So our cost of goods sold then would be 80 units at $6 per unit. Well, if we had 100 units and they'd cost us $6 a piece, and we sold 80 units that had a cost of $6, so cost of goods sold at $6 a piece, what would be left in ending inventory? Well, if we had 100, we sold 80. What we have left then is 20. And those 20 units left in ending inventory would have had a unit cost of $6 each. So that's 20 at $6. That's what's left in ending inventory. Then on the 11th of that particular month, we make a purchase. We purchase 150 units. Those 150 units cost us $6.50 each. So that's 150 at $6.50 each. Well, now let's look at what we have in ending inventory, or inventory at this point in time, not the end of the month, but inventory on the 11th day of this particular month. We had 20 units at a cost of $6. Well, we still have those. So now what we're going to have is 2 layers of inventory, and we have to keep those separated in layers because they're at 2 different unit costs. So we have 20 at $6, and we have 150 at $6.50. So now our inventory at this point is 20 at $6 and 150 at $6.50. That's 2 layers of inventory. Now it's very important that we keep those 2 layers separated because we're using the FIFO method of valuing inventory. And when we make a sale, we have to sell off the top layer because remember, FIFO means first in, first out. So the first unit cost that came in is the first unit cost that goes out. So that leaves our inventory to be valued at the last unit cost. So 2 layers of inventory. Very important that we keep those separated. Then on the 13th of the month, we make a sale. We sell 120 units. Now, using FIFO, first in, first out, we need to look at the cost of those 120 units that we sell. Well, if we're selling 120 units and the cost is coming off the top, FIFO, first in, first out, that would be 20 at $6. So I'm going to put those in parentheses. 20 at $6, that would have been sold. And we sold 120, so that's 20 at $6. So we sold 100 of these at a cost of $6.50. So there's 100 at $6.50 that was sold. Well, if we've sold all 20 of these, and if we've sold 100 of these, what we have left in ending inventory, or inventory on this particular day, is 50 at $6.50. That's what's left in inventory now. 50 units at a cost of $6.50 each. Then on the 20th of the month, we made another purchase. We purchased 160. Those cost us $7 each, so that's 160 at $7. Now let's look at what we have in inventory at this particular point in time. We had 50 at $6.50. Do we still have those? Yes, we do. So our inventory first layer over here is 50 at $6.50. Plus we have 160 at $7. So that's our second layer of inventory right now. 160 units at $7. Then on the 27th, we sold 100 units. So let's list those 100 right here and let's figure out which 100 we sold. Now remember, FIFO, first in, first out. So these 100 that we sold would have been 50 valued at $6.50. I'll put that in parentheses because we're selling all of this layer and part of this layer. So this 100 would have been made up of the 50 at $6.50 and 50 of these at $7. So that's another 50 at $7. So now, if we have sold this 50 at $6.50 and we've sold 50 of these at $7, what's left in inventory now? 110, and that would be 110 at $7 because these 50 have sold and 50 of these have sold, so that leaves us 110 at $7. Now, if you had a perpetual inventory record that was being kept on computer, you would of course extend all these costs. I have not extended those costs simply to keep so many numbers from being on this page and so as not to confuse us with a lot of information. But if we were to make a balance sheet right now, we would need to know the value of our ending inventory. And we know that we have 110 units at $7 each. Therefore, the value of our ending inventory would be $770. So if we prepared a balance sheet right now, we would have inventory $770. Now, we just used perpetual FIFO. And of course, when we were saying we sold these units, we didn't mean the actual unit. We don't know what unit sold. What we were assuming was a cost flow. We assume that the first cost that came in were the first ones that went out, FIFO. Therefore, our ending inventory would be valued at the last cost that we paid for those items. First in, first out. The first cost that came in was the first cost of goods sold that went out. Therefore, our inventory would be valued at the higher cost in a period of rising prices. So our inventory would be valued at a higher cost. And that's the perpetual FIFO method of valuing ending inventory.